Good day, everyone. My name is David Williams, Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled COVID-19's Rapid Changing Impact on Asia Pacific. We are grateful to our moderator, Dr. David Broadstock, and our distinguished panelists for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations, along with a host of other products and services that you can find at our website, www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over to our moderator. First, this webinar is being recorded for those that cannot participate in today's live event. If you have any questions for the panelists, please click the Q&A button at the bottom of your Zoom window and type your question. We've allocated sufficient time at the end of the webinar to address your questions. And now I would like to introduce you to our moderator, Dr. David Broadstock, Deputy Director of CSIF, Hong Kong Polytechnic University. David, over to you.
Thank you, Dave. Just light up my screen. There we go. Okay, so thank you very much for the introduction, and thank you everybody for attending. I especially would like to thank Dave Williams and Rebecca Lilly for their efforts in staying up so late to help us host this on Hong Kong time. So today we're going to have a discussion around COVID-19's rapidly changing impact on Asia Pacific electricity markets. This builds upon a recent webinar in which several discussants looked into a similar topic on a global scale, whereas today what we're going to do is spend more time taking a deeper dive into the Asia Pacific context. Before I hand over to the speaker, it's necessary, let's say, for me to do a few introductions for myself and where I spend the majority of my time. I'm with the Center for Economic Sustainability and Entrepreneurial Finance at the Hong Kong Polytechnic University. We take economic sustainability and especially green finance as part of our core, and understanding what's happening with the economics of energy and environmental topics are critical to our thinking and the activities we undertake. I won't bore you with our agenda, although you'll be able to look back at the video and take a look at how we wish to serve our stakeholders. However, I would like to highlight that knowledge transfer is key to what we do. Our group, and I'm sure the Lantau Group and everybody involved with watching this webinar, are keen to aspire to be a leading force in everything they do, and we've specialized in education and scholarship, and to achieve this we place huge value in knowledge transfer. It's one way in which we can stay on top of the most pressing research issues facing society and learn what is the most important research agenda to go forward. The university I'm with is specialized in applied research, and we like to try to integrate that with society as best as we can. These webinars are an important way to build communication between industry, academia, and governments, and of course, the wider public community. 1 minute about our speaker, although I'm sure Mike will introduce himself in just a moment. Mike is founding partner of the Lantau Group. The speech marks here represent the tagline for the group, a leading strategy and economic consultancy focusing on the Asia Pacific energy industry. Very briefly, Mike has degrees in economics and public policy, leaving him well positioned to talk to our audience, and has more than 30 years of consulting experience focused very heavily on the energy sector, primarily on the energy sector, I should say. And his experience is illustrated by the amount of testimonials and testification he's given, if testification is actually a word. He has testified or advised as an industry economic expert across many countries in the region. I am very sure we'll enjoy Mike's talk. Following Mike's talk, we'll be having a short discussion from David Wogan, Assistant Vice President for the Asia Pacific Energy Research Center, where David is responsible for modeling. David is trained formally in mechanical engineering, but also has a master's in public affairs and is currently formalizing his studies in economics. David has lots of experience within APEC as part of an advisor to the APEC member countries, and previously worked with CAPSARC, who I think many of you would have been watching Adam Szyminski's webinar just 2 days ago. CAPSARC is a long-term supporter of the IAEE, and I'm sure David's experience there will be valuable here too. I have my own basic housekeeping. Use the question and answer function appropriately. Slides will be made available after the talk, and my terrible strapline is the British sense of humor. If you do hear a fire alarm, do not just switch off your browser, leave the building. Okay, so without further ado, I will pass the floor over to Mike. Mike, the floor is yours. I should say that we are socially distancing within the same room.
Hello, everybody. It's good to be part of this. Just a sec. Okay, just switching to the right way to share my screen.
Escape.
There we go. All right. Well, thank you. I want to take you all on a little bit of a journey through some of the data, some of the things that have been going on, some of the things that we've been seeing across several of the countries in the region. And it's a somewhat longish number of slides, but since it will be made available afterwards, I will go through several of them quite quickly. And if they generate questions, we'll focus more on the Q&A side. I have many people to thank for this, and their names are emblazoned on the disclaimer, where we take no responsibility, but we give lots of credit. And then very briefly about our group. You can find us on the great vast World Wide Web and get a little bit of an indication of our speciality in the economics, energy sector within the areas that are largely in the darker blue color on the map on your screen. And our focus is pretty much all things related to decisions, whether they're regulator decisions or commercial decisions or transactional or strategic or policy decisions, where economics has value applied to energy. So no real surprise. So let's get right into it. First off, on slide 7, it's just a quick snapshot of approximately where we are right now across the parts of the Asia Pacific region anyway, in terms of the number of cases. Now, I'm not going to go into great details about what is the right metric for measuring COVID's progression across the globe or across the region. But I just want to highlight that in some countries we are definitely flattening out, and in other countries we are definitely not. So this is still very much an in progress observational data exercise. We fortunately in Asia have a very different mortality profile than the rest of the globe. Every one of the countries we track is well below the average number of deaths per million worldwide across at least some of the tracking samples, and which is very interesting. But it probably will have some implication when we talk about how the economies will recover, or what evidence we're seeing for recovery, or what relative role Asia might play in the recovery across the globe, depending on the relative impacts. It has not been as great here. Demographics probably plays a difference, but that's really for the epidemiologists, but it is data, so it's interesting to me from the point of view of, we do have countries or regions in the Great Asia Pacific area which have roughly similar age profile as, say, the US. Hong Kong is a good example of one that has an over 50 and over 70 age group that is roughly similar to or even larger than the USA. Whereas quite a few of the faster growing ASEAN countries are actually much younger, with the Philippines being extremely young country. And so you'll remember in the previous graph, the Philippines is one of the countries that still has a relatively rapidly increasing case count, but it doesn't have anything near like the same kind of mortality that we see in other countries. Perhaps that is a factor. So looking at what has happened in each of the countries, let's just start with something that is maybe closer to a cycle. Hubei Province in China, the beginnings of so much of the awareness of this. In January 20th, you have the confirmed human-to-human transmission. The movement control orders go into effect on the 23rd of January, and you can just watch electric power consumption decline precipitously from that point on, bottoming out sometime around early March before it started to curve back up. You can see where the February 18th was the peak confirmed reported cases, and you have the peak daily deaths, and then the ratio of workers resuming in larger numbers goes up from 22% to 68%, so you can start seeing the recovery. And then compared to 2020 versus 2019, you can see, more or less that it took a big bite out of electricity demand, but at this point, early June, by the end of May, we're actually pretty much the same as last year. So China's electricity power growth rate is, of course, not zero from year to year. So this isn't exactly the same as standing still or normal, but it is a quite substantial reflection of sort of what happens as this works its way through as people get going back to work, assuming that there are no further downstream effects on international trade or a second round. Now, the responses around the region have actually been pretty strong, pretty strict, although they've also varied quite a bit. So from the very beginning, you've had your home quarantines, your lockdowns, your border restrictions, your travel restrictions, and in various countries, these have started earlier or later. Singapore is just at the end of its major circuit breaker. People are just starting to go back to work. Hong Kong's been relatively normal, except that we don't have in and outbound traffic anymore because of the 14-day quarantine. If you come into Hong Kong, mandatory. New Zealand and Australia have just begun to ease their controls. And I think that I have a lot of Australian friends who will probably get out of the house this weekend and do something social for the first time in some time. Philippines, Malaysia, Thailand, different degrees of movement control and different degrees of effectiveness of those. Perhaps a little bit less effective in the Philippines, extremely hard place to do this, but pretty effective in Malaysia and relatively so in Thailand. So Korea, Taiwan, both have actually managed to reduce or keep less the more stringent controls because they focus more on tracking and tracing and isolating the cases rather than the mass quarantines. And then you see Vietnam, which has actually come through with no deaths so far as I know, and although various levels of business shutdowns, etc. And then, of course, across the whole region, you have far, far, far less tourism and other normal interactions, economic interactions have pretty much ceased in that regard. Give you an example of Malaysia before we get into just how these things have progressed. So around the beginning of March, you pre-movement control order, MCO, you had 22 cases, then 25, and then it started to pick up, 117 growing up to 900. First movement control order, the second one, third one, fourth one, and they've been relaxing it more recently. So you can see the variations in some of the actions that have been taken, and Malaysia is slowly getting back to business currently. So it's largely been the lockdown measures that have had the most profound impact. Of course, that's not a rocket science statement, but as you recall from the Hubei Province pictograph, you can see that, you know, as those things end, there is the prospect of returning to normal, which is one of the things that I think most of us are very interested in seeing, just what new normal emerges. But the immediate lockdown effects, dates, you can see what kind of profound impacts they've had. Different countries, and New Zealand, Australia, same type of double-digit, oftentimes, change. And the week that followed tended to settle down a little bit worse. You would say in Vietnam, it was about 7.8% reduction, but in Malaysia, it was almost 30%, 29%. Huge impact on Malaysia, short-term demand, 25% in the Philippines. Very, very profound, very sharp, very unexpected, somewhat difficult to manage from an electricity system perspective level. In the Philippines, I think many of the retailers declared force majeure on some of their contracts for purchasing power from several of the generating units. It just wasn't needed, and several of the generating units weren't running anyway. It's going to be an interesting resolution of that kind of commercial reality as we proceed. And just to give a sense, so here on slide 18, you see each of the countries that we're tracking here. Year over year, 10% down for Malaysia in March. March versus February, minus 8%. Australian, the national electricity market on the east, minus 6, minus 7. So year over year versus month over month. Philippines, minus 5, minus 1. And then China over this particular period, because it was hit first and started climbing out first, while its year over year, March 20th through March 2019 was down, March was quite a bit up relative to February because the restrictions were starting to ease. So you can see here's how some of the different countries, where they are in their cycles. And in Singapore, Taiwan, and Vietnam, it really in March, they hadn't hit the most stringent period of their movement controls or their circuit breakers, or they didn't have to because they had made other adjustments, and in which case their electricity demand actually increased year over year and month over month. Go 1 month further forward in April, now almost all of the countries except China are having movement controls, and so you can see that this pivots Vietnam, South Korea, Singapore, Taiwan into the negative month over month and year over year territory, but China is still returning more to normal with an increase even year over year at this point, and certainly month over month. And then if you click ahead 1 more month to the end of May, we just finished collecting all of this. So you still have Malaysia down 11%, May 2020 versus May 2019, but with more people able to go to work and more things restarting, May versus April has seen a relatively sharp recovery. And I guess I would observe that last month in the middle of, or in April, in the middle of, early April, in the middle of all of this, you know, one of the big concerns was, you know, how long will this go, and what happens to cash flow and businesses if they can't continue. So it is an interesting observation. Singapore is still down because Singapore wound up tightening its movement controls quite late. It had a very significant increase in in cases, almost no deaths in the Territory Republic, but the case count has shot up quite a bit due to a widespread infection in the foreign worker dormitories, which are closely packed, but it's also a very young, youngish demographic. But it's caused Singapore to put a fairly comprehensive, what they call circuit breaker, but really nobody can do much. So of course you see the negatives there. And Vietnam has continued to grow back, and Taiwan was the least affected of all of the countries in the sample. We would see the changes occur from a month to month, but we would also see them over the diurnal cycle. So if you drill down into, say, Malaysia, you can see that, you know, January month 2020 versus 2019, February 2019 versus 2020, we're actually still seeing growth. And then after movement control in March and April, it's negative, it's quite sharp. You can see kind of a flattening of the daytime cycles as the business, daytime business load is relaxed, and everybody's spending more time at home. You can see the shift in the diurnal profile. You can see the daytime peak moving down quite considerably, but the evening peak moving up quite sharply, again reflecting the increase in relative increase in activity and absolute increase in activity in the evenings, largely residential sector. Taiwan has been interesting because it moved almost as fast as faster than just about anybody to kind of control inbound traffic, inbound travel, and has managed to, you know, while the graph looks like a very, you know, it went up and down, it's we're talking about daily cases in the order of 20, 25, less than 30 a day. So really quite a small number, and most day-to-day economic activity, factory activity, industrial activity is actually continued. And consequently, a raft of GDP forecasts are still largely on the positive side of the ledger for the outlook, even those made relatively more recently. Not all, of course. No one can ever agree on a forecast, but it's a good, an interesting outlook for what happens with an economy that has managed to largely avoid the worst of the COVID, both health and economic impacts. Now, some of Taiwan's near-term fluctuations in electricity demand have actually been temperature. We're in the February to May, February to June period, which is, you know, when a lot of countries shift from they have their hot season, or they go through they haven't hit their rainy season, or it is a peak temperature period. And in Taiwan, you can see that in April, even though we would say demand went down in April, but so did the temperature. And then it kind of restored in May. So Taiwan has actually been quite a bit more sort of normal within range after you adjust for temperature, even through the COVID period. And you know, because of the temperature reduction in April, the 13%, 14% lower temperature than normal, you know, that's actually the more dominant effect. Conversely, in the Philippines, which has actually had very significant lockdown, it had that at the very same time that the temperatures shot up almost to, I think, 47, 48 degrees centigrade. This is May. May is just before the rains start to come a little bit and it cools off. It's usually where you see your peak demand. You can see how in the island of Luzon, the peak demand fell back 4, 5, 6 years worth of growth and has clawed back to roughly the 2017 level, just because it has been an extremely exceptional heat wave. And then in the Visayas, the fallback has not been quite as much, back down to 2017. restrictions were a little bit less and a little bit later, and it's less industrial. So just some quick headline points. COVID incidence rates are still not under control, but the mortality story is very different than what seems to unfortunately have occurred in other places, and that may well lead to a different approach to economic recovery, and it may make some of these easings of lockdowns and whatnot a little bit more permanent than they might otherwise be, but no one knows yet for sure. The lockdowns themselves have clearly had the largest impact, and at least so far where we see those easing off, we're seeing electricity demand restoring relatively quickly to similar levels as the previous year, maybe not all cases above, but certainly there's a little bit of good news from an economic point of view, economic activity point of view, that it's not persisting, say 10% lower, while the whole global economy sorts itself out. So in that way, Asia's maybe a little bit better positioned than some. Mainland China's recovery continues to show strength. That's actually still true and very much the case. And many of the other Asian countries are still poised to get back on the growth track, because it's just in the last week or so that we've started to see some of those return more fully to work, and we'll have to keep an eye on what that does to cases and whatnot. But just teasing out some of the factors, February to March is very highly variable weather, and if you don't control for that, then you can attribute too much to the underlying COVID effect, and that will sort out. And then because growth is already part of many of the Asian electricity systems, some of the adaptation that we would expect is largely going to be because of rephasing of planned investment. It will be much easier to not build something or to build it later than to deal in a otherwise slow growth environment with a persistent overhang and nothing to do but take something out of the system. So it should be broadly a market like Vietnam or even the Philippines. There's already been some rescheduling of supply side investment, and probably keeps the fundamentals closer to on track. So there's a broadly so far positive story we're seeing in the demand side. On the fuel side, obviously it's been very disruptive, but I'll make a couple of observations. Certainly when anybody talks about fuel and fuel stories, they're always easier to develop what the story was after things have actually happened, and you've had some time to put some words to the shapes and stuff. So after the fact is not really all that helpful, but just two observations. One is, yes, it was very dramatic when you had negative WTI prices in March, etc. But if you take a broader month average look and you look at dated Brent, which is more the globally traded rather than the US specific metric, the kind of price reductions that we're anticipating for the average for the 2020 versus the previous year, it's not the first time we've been in this level, not even the first time we've been in this level of overall average projected reductions, in the last several years. So while the sharpness of the price changes went in a very short period of time, and the depth to which it went in March, it's still looking like by the end of the year, the expectation is it will have be quite different. Let's take a look at that. There are two ways you can see what fuel prices do to electricity markets. One is kind of just take a snapshot of what the normal merit order would look like. Roughly your renewables and your nuclear and coal and LNG and oil would be your snapshot for the Korean market, which is quite a diverse range of fuels and technologies. And at this point, more or less with the fuel configuration of fuel price configurations, a mix of coal and LNG are pretty much interchangeable. The red lines are pretty much dots that are some of them. The LNG is no longer to the right of the coal. Some of the coal is to the right of the LNG. Some of the LNG is to the left of the coal. So at the kind of prevailing price levels, even from a short run dispatch point of view, we really have a very changed merit order. And of course, anybody making investment plans is going to be looking a little bit more on the gas side than on the coal side if they can get comfortable with the longer term outlook. So what does that look like? Again, the dated Brent price fell quite precipitously in March and April, but if you look at, on the right, you look at sort of the forward curves over the last several years, there's a, there's been quite a wide range of prices since 2008 to 2008. It's been a little bit narrower since 2014. Of course, it's going to be narrower the fewer years you give. But if you just look at all of the pointers out for the 2025 price, it's an interesting kind of singular destination. Another way to look at it is the interactions between the Brent price and say the red line of the so you have U.S. oil production barrels per day, that's the blue line. And then your Brent outlook, which was going up just before U.S. oil production started to increase. And then as U.S. oil production increased quite sharply in a short period of time, the Brent price also started to come down. I'm not linking these two only, but just highlighting that what we're now seeing look ahead is a very, if you look at the right-hand side of the blue line, the U.S. oil production is going to probably continue to fall down quite a bit. And so there are some sort of offsetting factors that we would keep an eye out for to see what is going on. Now, everybody likes Italian food and everybody likes spaghetti. So let's just take all of the forward curves that that can be generated from the data back to 14 January. And if you go 14 January arbitrary, but just before COVID, you can see that it started up at around 62, 63, and in the long term it was kind of finishing up around 60. And in early February it was still around there. So the immediate impact of awareness of COVID hadn't really penetrated the oil markets, but if it was going to have an effect, it was going to be in the near term. This very much was the trend all the way through, that the sort of 2020, 2021 outlook fell precipitously, bottoming out around 29 April, around 20 something dollars or a little bit less. And then since then, as of June, the near term has sort of moved back up to around 35. Much more volatility at the front, as you would expect, but the back end has really been quite stable with in fact, very recently, the 29 May price is just about the same for 2029 as it was 14 January. What's happened is the middle and the beginning. So we're all still aiming to roughly the end point. The markets still think that's roughly where that all ends up, but the journey between now and then is going to be very much more bumpy, a lot more volatile, a lot more uncertain, and so far it is already moved in the last month or two, quite substantially. So it's just an interesting kind of outlook to watch. Now, as oil and gas prices have fallen, so too has coal prices, but the coal markets in the Asia Pacific region are exceptionally influenced by China as one of the significant importers of Indonesian and Australian coal in particular. So where you saw the February and March, January, February, March sort of reductions in Chinese electricity demand, and then you saw the April and May beginnings of the recovery, it will be very interesting to see what that does to the spread between coal prices and oil and gas prices. China's not a big consumer in its power sector of natural gas, so China's recovery will have a much smaller impact natural gas prices than it will have on coal prices. So that will have implications for people's subsequent investment decisions through the region, possibly favoring gas for a longer time. And you can see this on the next slide, where we've just looked at China's fuel mix from January, February versus March, and you can see that thermal, which is largely coal, it had been growing at 5.5% per year from 2017 to 2019, but it was down 10.5% at the beginning of 2020, comparing Q1 of 2019 versus Q1 of 2020. One of the reasons it wasn't down even more, perhaps, was that hydro availability was much less through some combination of conserving water for later, but also lower inflows. So the China's managed to moderate that impact on coal demand. But as you go out, if you go out further, we don't have this slide in this pack, but you'll see that the thermal uptake has started to occur again. So this is something we would be watching. So we would think that coal prices should recover a bit faster, just because they're going to have a very different dynamic in terms of the number of countries, where they are in their recovery and how they actually each use different fuels than the normal situation we would see. So what does this mean if you're a utility in the region or a company operating in the business in a sense? So we've created a generic utility cost structure based on several companies in the region, kind of a pan-Asian average mix, with generation including fuel of around under 50%, around 45, 47%. The generation capacity kinds of cost around 23%, transmission roughly 10%, distribution roughly 16%, so about 25% or 26% is T&D, and then other, which is retail and operations. And it's going to be plus or minus around those numbers for just about everybody in the region. And then you say, what happens to revenue collection or to tariff pressure to correct for revenue impacts based on the demand changes, or what we'll call demand destruction aspect of COVID, versus the fuel cost relief aspect of the fuel markets? And remember that demand reductions are immediate. People use less, they pay less. So the cash flow implications are immediate and negative. And so if you've got, say, a 15% reduction in your gigawatt hours sold, to make up for that, you would actually, all else equal, have to raise your tariff if that were the persistent situation by 9.5%, assuming no change to your fuel cost. And then if you say, well, in the easing period, it's no longer -15, but it's some kind of persistent -5. And in the recovery period, we don't quite get to normal because we're an interconnected planet. And this is a global situation that we just stay a little bit below. Then you can roughly translate that into broadly what kind of all else equal tariff increase would be required to keep to revenue neutrality, cost recovery neutrality. And then, of course, you think about the fuel cost part. And coal price in the very, very beginning of the lockdown period was actually still going up, but it then went down 22%, 16% over the period. The gas price change went down almost immediately. It was generally linked to oil prices, Brent, through various formulas, and then 54%, 41%. So then total fuel cost impact, depending on a 50-50 coal gas mix, is -4%, -5% in April, May, but -16 and -12. So you get some sense that the demand destruction, as long as it stays relatively short term, is a cash flow problem. And the fuel cost part largely more than offsets that from the potential total savings. It's really just a question of how does that play out with the regulatory periods? How is the total net impact covered? What is the exact fuel mix of each of the countries? What is the exact form of pricing, mix of the contracts or spot kinds of purchase? But you get some sense that over the next couple of years, going back to these forward curves, we're not expecting fuel prices to go up to their previous level for some time. So broadly speaking, across the electricity using community in the region, the fuel cost reductions are going to dominate the story. This just gives you some background. It's in the pack for the interested reader. So when this all started, the global financial crisis was often heralded as about the only sort of in our lifetime direct comparator we could immediately refer to get some bearing on how this plays out, making some assumptions that somehow the health aspects of the recovery profile would be well behaved, and the largely liquidity aspects of the recovery, people making it long enough to stay in business, long enough to get to the other side, is more like a global financial crisis where you have a sharp liquidity difficulty in getting or maintaining or obtaining debt. And that pointed for like the Philippines, which was a well-performing Asian country during the global financial crisis, never went negative. It took about 9 months, 15 months roughly, to get to the very bottom, and in about 9 months to get back up to recover, and that gives some idea. And so, some folks have been wondering, does that mean 2021 is a good year and 2022 is a fine year? Obviously, it's too early to say. And I think different people are coming up with different patterns, and I'm not really in the pattern forecasting business, but just to get some idea of what's going on, taking into account the diversity of what we've seen throughout the region. This maybe puts it in a little bit sharper perspective. The global financial crisis impact on real GDP growth rates year over year across the number of Asian countries, we just aren't through enough time to see what kind of, we're just speculating here. So it'll be a very interesting thing. The only thing that we can say from the electricity data is that if the mortality stuff stays under control in Asia anyway, we're likely to see a reasonably good recovery of electricity demand, if not a resumption to the old growth rates, at least to a previous one, acceptable one. There'll be some sectors that will be hit more dramatically, flights, tourism. This is not a direct Lantau Group specialization. We don't look at this aspect, but we do a lot of demand-related forecasting. And so a country like Thailand, a number of ASEAN countries derive a significant amount of revenue from tourism. And so, those will be some of the bigger sectoral impacts and drive a lot of the net economic impacts. If you take Thailand, you can see restaurants, hospitality, etc., are all pretty big. I'm going to skip over the interconnectedness of the markets. We won't really know too much more about the impact on ASEAN countries until we have a clearer idea of where the endpoint is for Europe and the USA. But China will be a very significant factor no matter how it plays out for the rest of Asia. So just kind of coming to sort of the last several little bits, and then we'll get to questions. Diversity, the region, Asia-Pacific region, for those who know it, know how diverse it is, whether it's different industry mixes, whether it's different fuel mixes, amount of gas versus coal versus other, or whether it's the growth rates, a growth rate of, in Vietnam, it's been almost 12% per annum. So you can take a pretty big hit and you would still be growing. So the real questions for markets like this will be more the sectoral impacts and the ability of the electricity sector to adjust new build versus new demand. The impact in China has been very profound. From January to February, you can see how many of the eastern and southern areas in China had seen negative demand growth, whereas other parts of China in the north and the northeast were still growing. And then by March, the numbers, the negatives were smaller, and by April, actually, relatively most of China's economic activity zones were going positive. And the impact on different companies is going to be very variable. Again, playing out the who got hit hardest by demand destruction versus who benefited the most from fuel mix is going to play out very unevenly depending on where you are, what your assets are, and how that actually plays out with your regulatory arrangements. I think one of the interesting things for many has been their electric bill. If you're a residential customer and in the Philippines or in Malaysia or countries which have graduated rising block tariff structures, and you're spending a lot more time at home, you're using more power, yes, but you're also using more power at progressively higher tariffs. Different markets in the region will see different impacts because of the way use has shifted. So here's China's during the middle of this secondary industry and tertiary industry, give you some ideas of what those were. All went down. Residential went sharply up, and not of course offsetting this, but it will have a profound impact on customer bills. And here you can see the kind of rising block or fixed volumetric tariffs that apply. So you can get some sense if you're kicked into a higher tariff class, as a result, your consumption might have gone up 20, 30, 40, or even 50%. You will see some bill shock, and it remains to be seen how that will play out in terms of customer preferences for emerging technologies behind the meter. Similarly, what pressures it brings for tariff reforms or for things like lifeline tariffs or adjustments or protections. Cross subsidies are a common part of Asian electricity pricing, and by cross subsidy I mean places where the domestic tariff is significantly lower than the commercial and industrial tariff, and largely that's because it's not based on a cost to serve model. Versus markets where it's relatively policy oriented or regulatory structure oriented, not to have a manifest cost subsidy across different customer classes. So this, of course, is going to affect different countries differently, because if you're cross subsidizing your domestic tariffs, or they're low, and your C&I tariffs are higher, and your C&I tariffs are hit hard, customers are hit harder by the macroeconomic and pandemic effects, then your revenue loss is going to be increased compared to others. There have been a number of ways to protect customers throughout the region. I'll just leave this as a list. The obvious policy response to try to bridge the gap between the tariff and the lower fuel costs to come. So generally, you see demand reductions, you see fuel cost reductions. How this plays out is a related rates problem. Which one hits first through the process that adjusts tariffs? Lockdowns have been the biggest part. The end of those lockdowns will define how fast you get to the fuel side, and possibly what pressures are on the fuel markets. So finally, investment. We think that a lot of the countries who have already started talking about ways to stimulate their economy or to protect their economies from further demise. And so issues of resource projects, power projects are part of the talk in several places we work in. And China in particular looked like a place where they had a traffic light system. If it was red, you couldn't build coal, and if it was green, it was okay, and if it was amber, it was a little bit difficult. And you can see that coal had been pretty much shut down out to, in 2018, the outlook for 2021. But in 2019, the outlook for 2022, and in 2020, the outlook for 2023 has changed quite a bit. Does that mean they will build coal? It's hard to say, but it means that the manifest restrictions are off. And interestingly, China doesn't have very much coal in the pipeline at the moment. There hasn't been very much approved coal. These are in gigawatts. They might seem very large to many, but China was building 50, 60, 70 gigawatts a year of coal for a number of years in a row. So this is really almost zero from that perspective. So it offers an opportunity for maybe for gas or for something else, but that hasn't happened yet. Finally, with renewable energy, everybody, I think, looking at the fuel prices for conventional fuels wonders whether that's going to cause a reduction in interest or the reduction in commercial potential for renewable energy that competes with, say, on-grid prices set by, and you can get some sense that we probably lose a year, maybe we lose a year, maybe we lose a year and a half of technology progress as a result of a fuel-related reduction in the electricity price for on-grid work. But we're not really seeing a change in, not any real change in the country commitments, which are really at early stages in this region. Even in Malaysia, they've just announced what they call LSS4, I think it is, for large-scale solar. So there's still expecting this to continue. So it's just to summarize and try to keep within time. We've got a huge disruption. There's no question about that. We're not. It's been sharp. It's been profound. It's been very difficult to get a head around. But it is driven by certain factors that we are watching, and we're starting to see come out the other side with a recovery of demand. The fuel price story becomes a longer-term risk story because that's very much driven in interacting with the demand story. And some disadvantage to grid-connected renewables. But if you're on the rooftop, you're a little bit less sensitive to that because usually the arguments are much more about the tariff design than about the fuel component of the tariff. Our spikes or uncertainties in prices that can also feed to customer preferences for managing their bill. There is probably some kind of parallel to the GFC in the sense that, at least in Asia, the length of time may not quite be as long as, it's early to call this, but it is improving maybe a little bit faster than I thought it would a month ago. So we're watching. And most of the Asian electricity sector is a little bit better positioned, either because of the fuel mix or the benefits of the fuel cost, or where they are in the growth cycle, or where they are in the investment cycle. See where we can get to with questions.
So,
yeah.
Take over.
Okay.
Okay, so with us 2 seconds. So thank you very much, Mike. For those of you in the audience, you can see that Mike and I are actually in the same location. We have been applying appropriate social distancing etiquette during the presentation. We're just taking a pause from that just to switch the screens. I would now like to actually bring in David Wogan, who's going to be discussing on the slides on Mike's presentation. So David, I think you should be able to start sharing your screen. Would you like to take over? Thank you.
All right. Good day, everybody. Again, my name is David Wogan. I am Assistant Vice President and Senior Researcher at the Asia Pacific Energy Research Center based here in Tokyo. And I want to thank David for moderating, Mike for a wonderful presentation, and the organizers for this opportunity. And Mike, again, thanks for running through an insightful overview of how the energy system and particularly the electricity sector have been impacted by the COVID crisis. You provided a data-driven analysis into the complexities of the electricity system and the diversity of policies, regulations, and markets across Asia mean that there's rarely a one-size-fits-all sort of conclusion or type of analysis. And I think you did a great job at sort of teasing that out for us. And I think one takeaway is that the reality is quite complex and diverse. And I want to highlight a few points to use as basis for discussion, and I'll spend the next several minutes going through them, and then I look forward to your thoughts and reactions. And a quick disclaimer: the views and questions in the following slides are my own and do not necessarily represent those of APEC or any member economy. And so with that, I've identified six thoughts that I'd like to draw attention to. The first is security of supply. Second is tariffs. Third is coal-fired generation in China, followed by renewables, the recovery, and then wrapping up with decarbonization. Now for security of supply, in your first section of slides, you provided a helpful summary of the policy responses across Asia Pacific to contain the spread of infections and the subsequent impact on electricity demand. In effect, we're witnessing, I think, a global experiment in isolation through movement controls and circuit breakers. And prior to COVID, we were observing some movement toward deglobalization and protectionism through onshoring of manufacturing and different trade policies and other measures. Yet there is evidence that trade was quite effective in COVID, such as allocating masks and other items to where they were needed. Thinking about energy, you point out in slide 40 that some markets like Singapore, Japan, Thailand, and Korea benefit from lower imported fuel costs. As we come out of COVID, I'm wondering, do you think isolation manifests itself in the energy sphere, or and do countries tend to look inward to a greater degree? And following along this thought, does the interdependent shared resource model still work? Or should we expect more focus on domestic stockpiles and extraction of resources? For example, more domestic coal, fewer gas imports. But also, to what extent is regional electricity trade insulated from or even buoyed by this? So that's the first point. The second point is on tariffs. And intersection on impact on utility costs, you show how lower fuel costs are likely offsetting lost revenue from electricity sales. Later in the presentation, you also showed how the rate structure plays in the context of demand destruction. I think this is very important for countries with cross subsidies and regulated price regimes that are very common in Asia, as you showed. And particularly the inflexibility in the price mechanism to deal with these types of shocks, especially of this magnitude, can create unforeseen distortions and feedbacks. And I'm wondering, have you observed any distortions or unintended consequences in systems with these regulated price mechanisms? And do you foresee anything in the future that regulators should be aware of? My hunch is that shocks of this magnitude expose some of the limits of inflexibility, particularly on a government or regulators' inability to recover costs. And you mentioned that future tariff reforms may be necessary. So I'm wondering, do you foresee governments and utilities updating the cross-subsidy regime or moving to a more cost-reflective tariff structure, or is this not enough for structural change? Moving on to the third point, for me, this was the most shocking, or most interesting, I think, kind of point in the presentation. Talking about coal-fired generation in China, it's presented as a risk assessment of new builds, and we can see that there's more gas capacity in the pipeline than coal, but you note the possibility that coal could be favored on economic activity grounds. And there is always an ongoing tension between decarbonization and socioeconomic development. And past experience has demonstrated that socioeconomic considerations win out, even in times when we think maybe they should not, despite the rhetoric to the contrary. And so your slides suggest China may make this determination again. How would a return to coal play out in the global stage of climate change negotiations? Would it be seen as leverage for other countries to put multilateral pressure on China? Or is sort of a return to coal part of a larger trend that other countries might experience? On to the fourth point, specifically about renewables. On slide 70, you note that renewables will be more exposed to falling fuel costs. Popular narrative right now is that renewables are a big winner from through the pandemic. However, I think as you've shown, reality is a little more complex. financial support and priority merit order contribute a lot to the renewables, quote, success story. But I'm wondering, is this sustainable as we move out of the COVID shock? Will developed economies come under more pressure to double down on such financial and policy support regimes? Do developing economies follow suit? And through all of this, what is the role for natural gas in the transitional power mixes in Asia? The fifth point is about the recovery. And it seems more and more unlikely that we will see V-shaped recoveries across the globe and even in some parts of Asia. Some forecasts are expecting, I guess, Nike swoosh type recoveries. So I guess you could call this a U or maybe an elongated U. Economist Nouriel Roubini is warning of a prolonged depression as he expects it will be difficult for jobs to come back. And many of those who do kind of reclaim their jobs may not have as many benefits. So we can imagine a world in which there is a larger Uberified gig economy that is the norm for more and more people. And thinking in economic terms, when we solve for the equilibrium, less income means less consumption, which can put downward pressure on energy demand, which can impact energy investments. I'm wondering, what are your expectations of how the electricity sector develops if we experience a longer, bumpier, and more depressing recovery? And finally, to close things with sort of the long-term view of decarbonization, several reports recently have put the temporary global CO2 emissions decline at levels in line with a Paris decarbonization trajectory that would be required over several decades. As you show in your slides, energy, especially electricity demand, is tightly coupled with economic activity. However, shedding economic activity is not really a sustainable approach for decarbonizing. And given what we are learning from the economic destruction from the response to COVID, what are the real or pragmatic prospects for decarbonization in your view? And to bring it back all the way back around to electricity, what would you say about the role that electricity has to play in this type of future? These are just some thoughts that I found interesting, and I think, David, I'll pass it back to you, Mike. Look forward to your thoughts and reactions. Thank you.
So thank you, David. I'll just dive in for a second. Sorry for the screen rotation to everybody. Thank you, David, for your comments. Really, I'll pass it on to Mike to give a response first, and then we'll open the floor to the audience questions. We have one or two that have come through the Q&A. So Mike, please, over to you.
Hi, everybody. Those are some really great questions. We should be able to get through them in about 3 or 4 minutes, I think. So let's give it a try. Really like the categories. I'm not being facetious. I really think these are some of the very much timely issues. I put your first question, David, in sort of kind of an energy security context, in the sense that there has long before this, what many countries call the fuel mix study, or the energy sourcing study, or the energy security policy. And we've watched several countries in Asia variously undertake this with the question about how much to rely on imports, and if you rely on imports, what does that mean for your backup or whatever. But at this very moment, I think actually the preponderance of discussion or agitation for opportunity is probably access, cross-border access for green energy has been a theme. If you're a multinational in Singapore and you're trying to meet a RE100 kind of target, you're really looking for stuff that probably can't be done in Singapore within your time frame. And if you're looking at ASEAN countries, you're probably looking at different ways in which at least renewable energy can be sourced and traded, because the endowment of renewable energy resources is extremely uneven, and money chases that. So I think that aspect of this is something we're going to see more of. Whether there's, I want to use my gas rather than LNG, or whether I want to use, how we balance the development of domestic gas resources versus internationally traded gas resources. I think that's been something that's been stuck. I don't really have a scientific term. I'm just going to say it's been stuck in a practical way for several countries for some time because of the complexity of needing a regulatory, commercial, market-based overlay, not just on the supply side and the infrastructure required, but on the use side. So what is the incentive and risk of a party buying gas-fired electricity that is exposed to global market prices? How does that ripple back to the customer or to the shareholder? And domestic gas is much easier to play with within a controlled, administered environment. And I think that has been the enigma riddle thing that has to be unpacked. I think your next, it's not a perfect answer, but I'll stop with that. We're seeing green, we're still seeing transmission as being something that will develop further, I guess, and trading of some sort will be developing further. But we're not seeing lots of emerging wholesale markets. So it's sort of bespoke arrangements. So we'll watch and see whether those can really work. Tariffs in the region are very under a wide range of regulatory and policy models. We have completely government-owned, legislature-controlled power sectors, such as in Taiwan. We have completely privatized, more or less market-based in Singapore and the Philippines, and then we have a raft of intermediate and different models in different places. The tariffs are generally not, except for a very few instances, not structured for these kinds of stresses. Whether it's a changing fuel price or a more volatile fuel price that has to be adjusted quarterly or monthly or annually or 3 yearly. The cycles vary across the region. Some are more frequent, some are less frequent. If it's less frequent, it's more risky politically because we can see what kind of price changes can occur. And they're great when they go down. And maybe we will see some what you might call favorable adjustments. But what happens if demand recovers a little bit faster than the markets were expecting? What happens if the chill in investment clearly happening in the oil and gas sector goes deeper for longer because of the additional risk of renewables and other things that have to be factored in and not just the demand recovery? Then honestly, it wouldn't be the first time that you would see a price spike come a little bit faster than you expected. So it'll be a very interesting process. Those who benefit going down can pay the price going back up. That inflexibility will get borne by the utility or by the government, and there's no model. The other part is whenever you have a disruption of this kind of magnitude, particularly the demand-related destruction, the immediate cash flow problems to the utilities, if they correct for them in the next year, the next tariff adjustment, the next regulative cycle, all at once, that can be quite a significant increase. And so where the longer term fuel prices might bring you down, the ride to get there might go up before going down. Creating some kind of longer term regulatory balancing instrument, almost like a regulatory asset of a disruption that is spread out over some time, is an instrument that a lot of countries don't have in the region because it just hasn't presented its need. So that's an interesting one that we think may find some traction here or there. Your question about China, I'll be honest, we're all trying to figure out what the green lights mean in this context, because they were originally developed because of curtailment and also environmental and need. So you had a multiple range of arguments for where you wanted to see certain things happen. Mm-hmm. investment, infrastructure investment, what China is very much geared up for at the big project level is they can build coal plants very, very quick. So the concern is that you resume doing that. Now, there's not a super duper need for it yet. That is, we're not at a shortage level. What China's going to need more of in its power sector will be flexibility. And so whether a massive increase in the coal plants is really what's happening, or whether this is just relaxation of one part of the decision process, whereas actually other things are going to be more important in time, remains to be seen. But remember, the effect of COVID is very local. It's been, you saw the map of China with the different percent growths, negative in some places, positive in other places. So you're probably going to see some targeted solutions. Renewable energy, unfortunately, in some of the areas, it's strongest in some of the areas that have the highest growth rates already. It is more in the north and the west. So I don't know. Our team here at the Lantau Group are kind of working through our China scenarios, but this is one of them that I know would capture lots of people's attention. Do we think that China is any less committed to its renewable energy targets? No, we don't, and we still see. We actually see a larger amount of external investors still going into China looking at renewable energy. Several projects that we've got going on give us hope with that. Renewables, I think in Asia, in the very short term, with the lower fuel costs, very much policy driven. You have two things going on. One is if you're connecting a grid connected solar or grid connected wind, most of the markets don't have markets. So unless you have a formal process for tendering, or a formal process for feed-in tariff, or a formal process for auction, there's no way to just develop something on a merchant basis unless it's on your roof. So we do see local and international players looking throughout the region at the behind the meter rooftop segment, particularly for solar, and that plays into the cross subsidy story. The commercial industrial customers who have somewhat higher tariffs than their domestic counterparts, if we can't raise the domestic tariff, then they're subject to more of the risk. They're going to be the first adopters, and actually in several of the markets here, they're pretty safe bet, and so we'll watch to see what happens there. But it's not it's going to play out. That will be the other part. Though, is people like renewable energy not just because it's cheaper, but because it's less volatile. So I know my costs for 10 years. I would return back to, I think in a time like this, the better lens through which to look at fuel markets is not the expected fuel price, but the likely change in volatility. That is, under normal conditions, we might look at the fuel price and have a reasonable expectation. We might have a historically well-tuned idea of how volatile that is, or what risk factors go with that. But going forward, I think the range of drivers is going to be much larger, right? We have the uncertain impact on renewable policy. We have the uncertain medical science aspect of COVID. It's not a macroeconomic problem. It's a macroeconomic problem wrapped in a science problem, wrapped in a policy problem, wrapped in a people problem. And it's going to take a long time to play that out. And I think fuel markets are going to be, and so if you start seeing price spikes, even if it's just because stopping investment is easy, knowing when to start it again is trickier, then I think the volatility aspect becomes an interesting part of the story a year or two from now. Your last 2 points, less income, less electricity. I'll be honest, I'm in denial on this one. In the sense that, I mean, my accent, I'm originally from the US, and so I watch my country with manner of unspeakable words, but I don't know how that will play out, how everything that's going on will play out from a global macroeconomic. We have more than one thing going on now. All I know is that Asia seems like a good place to be at the moment from the perspective of, at least in the Asian electricity sector. It's still been a growth story, and if it's a slower growth story, we just don't do something immediately, and we're not left with a big overhang. And I think the big overhangs have been the hardest adaptations. So when you do the big fuel mix shifts, you've got stranded assets. Here we have a bit more room for a glide path. There's a handful of countries with significant excess capacity. That's, they've got their own story, own issues. But the vast part of Asia is actually a little bit more imbalanced. So we're hopeful. And then I think finally on the green part, I don't think you get to, I think all of us know in our brains and in our hearts that you can't get to any targeted CO2 reduction level with activity options that are available right now. I mean, goodness gracious, probably the strongest near-term driver for green at the moment is corporates asking for green PPAs, pushing governments to make options available so that they can do this stuff. Bless their hearts, that's wonderful, but that is not going to carry the whole planet to its destination. So either it's going to be a different technology, a different framework, and so I have to agree, it's not sustainable. We can't get there by destroying demand. And gas can play a bridge and will play a bridge, of course, but it is a bridge, and which means it's a bridge that you start sooner and end later rather than you start later and go on even further. So I think the gas story is something that probably should get more attention right now as an opportunity. I think it is very likely the coal price will not go down as far as the gas price, and it won't stay down as long relative to the gas price. So we're seeing confirmatory evidence of more interest in gas projects, more questions like, will China change the gas? You know, as like, or will do you think we should move quickly here, or but again, it's got a regulatory obstacle dimension. The infrastructure you need to make that work has to be unpacked. Let me stop there, if that helps.
We're gonna do the screen switching again. Okay, thank you, Mike, and thank you, David, for your discussion. So I'm just going to take a look at the updates into the Q&A. We have several questions. Well, there's one administrative question about participation certificates. So that's not for us to handle. The IAEE will follow up with you on that one. Let me read the last question from Victor Martinez. The economic stimulus and relief policies designed by governments across the world are a critical part of the economic recovery. Many of the stimulus are excluding conventional technologies and those drivers by fossil fuels. Germany supports electric car industry, and France supporting airlines with a commitment to carbon reduction targets are examples of promoting clean recovery policies. Are you expecting something similar in the stimulus packages in Asia specific? So what I will do, just to have some variation here, is actually, David, would you be willing to provide a first answer to this, and then Mike to give an answer? David, I think your mic is muted.
Sorry, I was muted a little bit.
There we go.
I mean, this is a very good question. I think this plays into the story about, how do we come out of this recovery? And I think there's very compelling, arguments made that this is an opportunity to sort of work in some of these different investment strategies, I think, to look forward to new technologies to help sort of boost economic activity. And I think this is also part of your story, Mike, what you were saying about decarbonization is that the existing technologies we have, you know, if you just do the math, probably won't get us to where we need in terms of aligning with any kind of meaningful kind of Paris type of target. And so I'm not aware or I'm not versed enough in some of the economic recovery plans within Asia, but it definitely seems appealing. I know in the US and elsewhere in Europe, this is a big, this is sort of a big topic that's being discussed. But Mike, maybe you have more insight here on the ground in Asia in terms of how, you know, sort of the technology aspect and investment plays into the recovery aspect.
It's a good question. I'm not going to have a definitive answer. I guess we're watching, and I think there's been a scramble in most countries right now just to actually deal with the near-term implications. But there are, I think, a lot of opportunities being taken to shape a transformation for some of the economies, and this has been an opportunity. This is part of that agenda, and there's no question about that. Details, I think we're still waiting to exactly see. I think Malaysia's move to one of its first projects in the power sector has been to accelerate, you know, one of its large-scale solar initiatives, and you could even argue it technically doesn't need that at the moment, but it is, so it's very much a positioning for the future. And if I am reasonably optimistic that we'll continue to see renewable energy, and we'll continue to see some of the, you know, green access kinds of things develop. But other technologies like EVs, we still have some ways to go in a lot of the countries for that, not just because of the lack of infrastructure, but you know, the demographics and a number of other aspects of how you actually make some of that work. We're seeing more talk on hydrogen. I think from our company's point of view, we've set up some internal initiatives to get out ahead on more of these technologies, because we see them as the necessary part of the conversation. But you know, we still think we're out front on some of that. We're waiting for the governments to kind of catch up with where we think we could be. But I think if we all see it as an opportunity and keep that song sung loud, I think we have a chance. That's probably what it's going to take.
I just, you made me think of one thing, if I can kind of jump in, is that the time scale of these investments matters a lot, because, you know, if we think back to the Depression in the United States in 1930s, infrastructure was very important boost to the economy, but that was essentially very short term, very immediate. You know, you can put people to work right away. Investing in infrastructure and even in hydrogen, I mean, this could be maybe decades long type of investment. And so I think maybe it's important to frame it in terms of timescales as well, because what you need now to get people back to work may not be what you really need for a long-term issue.
Exactly, and because it wasn't the thing on the tip of everybody's tongue right before, the prioritization discussions that take a longer time. So you just aren't going to be able to move that stuff first. So first thing you're going to see is something similar to what we've done recently done again, or certain sector support. But I know if you're also trying to attract foreign domestic investment or development of certain sectors, your focus has probably already been to attract certain sectors that probably fit with this longer term technology infused energy vision. And I would think those things would get accelerated or certainly you know, continue to see attention.
Okay, I'm going to switch the screen round. I'm just double checking that there is one more question. APEC in terms. Okay. So there's a question there about APEC and renewable energy going forward. I would like to do this. So David, maybe in a moment you can briefly comment on that question, but very briefly. And then my final question to both of you would be along the lines of, well, we have been hearing discussion of the possibility that this could, COVID, the coronavirus, could be seasonal in nature. And one thing I have not seen discussed really in any depth anywhere is what would be the possible consequences if that were true, and how might that play out in any of the discussions we're going to have about preparing forecasts or developing ourselves to support the market in moving forward. So David, perhaps you can go first and maybe very briefly comment on that renewable energy question. And then after Mike's comments, we'll be closing up the webinar.
Sure. I think there's, several ways to answer this question. One is purely looking at, where the renewable resources are, depending on what type you're thinking of, whether it's biomass related or offshore wind or even solar. But I think what is really important, and this is just to kind of amplify what Mike was saying earlier, is that the market structures and policy environment is very, very key in sort of whether a technology or class of technologies is successful. And so I think I won't give any specifics about different countries or economies, but I think where you have support regimes or a market structure that is set up where there are clear and flexible and adaptable regulations to handle different types of technologies, including renewables, so that investors can be rewarded for their investment, but also consumers benefit from these technologies. I think that's where they'll be successful. So my sort of evasive answer would be to think about the market and regulatory structure across the Asia Pacific as an indicator of where you might see success for some of these renewable development projects.
We've kind of got to, I agree with that. Sometimes we talk about looking at the world through four lenses. One of which is the fuel supply, economics and availability and infrastructure in a particular country. One of which, of course, is the fundamental supply demand trends in the country. One of which is sort of commercial realities, ownership, private role of government, private sector, financing, basic money issues. And governance issues. And then the last one, which is the first one, is the basic sort of regulatory regime. How do different things go? And so you overlay those. And then when everything aligns up, you usually see activity. We're definitely seeing a lot of renewable energy developments continuing to go in Taiwan and Vietnam for various reasons. The governments are committed to, in Taiwan, to still moving out of coal and also nuclear. And the relative economics of offshore wind has moved into a relatively favorable area. And the energy security part is relatively strong. It's Taiwan imports all of its fuels, and the money is available. The private sector, international and domestic, are all part of that. So that kind of has put Taiwan into a sweet spot for that. And Vietnam, with its growth, the difficulty of getting some of the larger scale projects done, it's actually been easier to get renewable energy projects done. That's why you've seen this explosion in literal gigawatts and gigawatts of renewable energy developed by many participants, whereas you've had some mega projects that have stalled for years. So again, I think that kind of approach is helpful in thinking about these things, like a decoder ring. So.
Okay, thank you very much. So with that, I think our time is done. So I'll hand it over now for Dave Williams to close up the session, although would just like to extend my thanks one more time to both the speaker and the discussant. Thank you, Mike, and thank you, David.
Thank you, David. IAEE wishes to thank Dr. David Broadstock and our distinguished panelists for an outstanding webinar today. We're very, very grateful for your expertise and your time. For those listening, this webinar will be available on IAEE's website for future download. If you're not already a member of IAEE, we encourage you to join by visiting us at www.iaee.org. Thank you for attending, and I officially close this webinar.